Hello, hello, hello. Welcome now, Stock Trades. Mic check, 1, 2, 3, mic check. All right, hope everyone's doing well today. In this video, we're going to go ahead and do a comprehensive analysis regarding the outlook for 2024 and a couple of announcements and just to summarize what happened this year and the overall outlook. So yeah, if you like it, definitely give it a like. And without further ado, this will be a comprehensive video. Now, we are going to be publishing this on the podcast, so we are going to be reading through these slides. Historically, I don't like to read slides. I've been trained not to, but in this instance, we will. So overall, we're going to be understanding the market dynamics and do a deep dive in this analysis. So these are for serious folks. I hope you guys enjoy this. So as the financial landscape evolves, CNBC has been criticized for disseminating misinformation, which some hedge funds have leveraged to their advantage, particularly in the realm of small caps. This document aims to dissect and present the intricate details of market movements, ratios, and trends that shape investment strategies and often obscured from the retail investor's view. Our commitment is to unveil the layers of complexity within the financial markets, providing insights into hedge fund tactics, market indicators, and potential for small caps to outperform. We're going to be exploring the historical context, current trends, future projections that could influence the weeks to come of where Wall Street will be putting its money. So we're going to start off with market misinformation and hedge fund tactics. So amidst the misinformation by CNBC, savvy hedge funds are exploiting the emerging trend concerning small cap stocks by analyzing the Russell 2000 in relation to the S&P 500. What one can discern a decrease in the price to book and relative price ratio, a phenomenon reminiscent of the period between 1999 to 2001. Historically, following a bottom in the disparity between large caps and small caps have demonstrated superior performance for an extended duration, approximately 12 years. The strategic insight is what hedge funds typically withhold from the retail investing community. My apologies. Let's go this one here. Upcoming research releases and channels. So in the forthcoming week, we're going to be taking screenshots from our Bloomberg terminal and conducting some high research output and deep dives. We have a couple of distinct channels that are labeled long range, mixed range, and short range. Here's a sample on how it looks like. This is the master table. This will be stocks that are in the short-term range of anywhere between 6 to 12 months and long-term time horizon and mixed. The criteria in which they are selected and analyzed is based on factors that are discussed within the stock terminal. But overall, this is how the table looks like. And what we're going to be doing is we're going to have the date added, the range term in terms of we expect this to be long-term, mixed, or short-term. Obviously, the ticker and the price when added and the difference between that range. And then overall, we're going to continue adding and removing this from the table form, which then you can correspond it with the long view channel, the mixed, and the small. If you haven't realized, we increased our prices on the subscription, given that we are inputting lots of Wall Street insights and taking insights from multiple hedge funds, head of research, analysts that submit their work to institutional investors. And I'm reading all this information and utilizing our stock terminal, creating an investment thesis, which is why our stock terminal now is $59.99. We are going to be increasing the prices for our lifetime access significantly. So please take advantage of this because you're never going to see these prices ever again. Because the data and I'm paying in the tens of thousands of dollars to run this. So we want to make sure that we sustain this for the longevity of our platform. So overall, this is how it looks like. And what folks are going to be realizing, and as well as the bullseyes and all the data we have, that you're going to be making your money and then some, and having significant returns based off of these, based off of this research. Again, no promises, as the stock market is wild, but overall, from the long-term perspective, and given the track record of this research, it's going to be very significant. Uh, so that's the point of this slide here. So let's go on in terms of the disclaimer here. Remember, this is an educational platform. Okay, so treat it as such. Okay, we want to be able to teach you guys first principles thinking. Okay. So market analysis and the Russell 2000 ETF breakout. So the IWM has recently experienced a breakout, signaling the onset of a period where small caps are poised to outperform, potentially yielding a high double-digit return. This breakout is supported by technical patterns and surpassing resistant levels. We talked about this earlier on this week. This is a collection of our research. There's going to be sections like presidential elections, PE expansions that we have not discussed that will be discussed in this video. So we talked about the noticeable gap in the circular point, which has been observed. And I had a question regarding an individual who commented saying, what happens if this gets retraced back? Well, that could definitely happen. But if you were to analyze the levels, we have not seen levels like this since 1999 and 2000. And after those, we had a decade of positive returns and outperformance over large caps. And another thing is that we're going to be going from a high interest rate environment to a low interest rate environment. And a lot of small caps are influenced by these changes. So there's my answer. Now, market momentum and S&P 500 projections. With the current stock market nearing its all-time highs, historical data over the past 73 years shows that when the market approaches within 1% of its peak, it rarely declines 20%. Instead, so if we were to say, if this has happened, give me the times that this has happened in the past 73 years, and the answer is 11. However, in such of this proximity, literally there was a recovery within a week, all 100% of the time. So this pattern suggests that the rally has momentum and the bull market is likely to continue, despite the preference of what short sellers are paddling. The anticipation of new highs in January, especially in the S&P 500, is a testament to the market's resilience, and I believe we are going to be seeing that. Now, in terms of analyzing the first half versus second half, if you were to analyze all the presidential elections in the past history of the United States and stack them up and create a trend line analysis, what you'll find is that the second half of 2024 is where the stock market will return majority of its gains. I believe, and majority of institutional investors and head of research believe, that the first half of 2024 is going to be yielding subpar to equal basis to possibly a pullback. Artificial intelligence and small cap inflows. Our extended research includes the artificial intelligence bullseye maneuver and significant inflows into small caps. As Wall Street begins to pivot into this sector, the strategic move is part of a broader anticipation of market trends, potentially leading to all-time highs in the near future. After significant drawdowns, historical patterns suggest that the market could see gains of up to 22% over the following 18 months. However, it's also common for such proximities to be followed by a pullback, which could present strategic entry points for institutional investors. Market sentiment in 2024 projections. In 2023, investors remained cautious, bracing for a recession. Yet the current market sentiment is tilting towards optimism, with positive indicators taking precedent. This is particularly true for the latter half of 2024, where substantial gains are anticipated by institutional investors. While our discussions often center around the S&P 500, it's important to recognize the dynamics for small caps. They actually differ significantly, necessitating a separate analysis. The market may take up to 3/4 of a month to establish a new time high. Anywhere prefaced between January, we should see headline stating that the S&P 500 has an all-new time high, with a strong likelihood of witnessing substantial gains before potentially a pullback and the second half of 2024 suggesting an increase. Now, this is going to surprise you. Presidential election and cycles and market performance. Our historical analysis of presidential election cycles suggests vibrant market shifts post-April in the second half of 2024, particularly affecting the S&P 500. On average, stock markets tend to perform better during election years with an 8% increase. Contrary to popular belief, Democratic incumbents have historically seen a 12.5% increase. This inverse relationship between a Democratic incumbent's popularity versus approval ratings and stock market performance during their election year has been consistent since 1952. So what does this mean? And let me digest this for you. So many folks believe that Donald Trump winning the presidency will add some significant gains to the stock market. That's actually incorrect. And I'm not saying this from me being a Trump supporter or a Biden supporter. I'm just following pure data analysis. Incumbents that are Democrats tend to outperform Republicans at a 12.5% versus 5 to 6% ratio analysis, given that Democrats actually, given what the stock market has beholden, that's what's happening, right? That's the data, right? You can't fight the data. If you go to Talking Heads and really, folks that have so many subscribers and just they like to talk a lot, they would tell you otherwise. And you would be surprised by how many people operate on false fallacies and non-evidence-based approaches. And it mind boggles you. To all the physicians that are actually watching, I want you to akin to this to people that practice medicine in the 70s and 80s in 2023. Yes, people. This fallacy does, and type of thinking does approach itself in Wall Street as well. So you can protect yourself from all these headlines that tell you otherwise. The stock market is actually ineffective by the presidential cycle. Again, Wall Street's Wall Street, right? Now, I might say for specific analysis regarding pipeline stocks, the battle between President Biden and former President Donald Trump, that could potentially have altercations, but the overall general stock market theme is quite different. It is relatively ineffective. Forward PE ratio and market valuations. So analyzing the forward PE ratio in relation to the S&P 500 currently is sitting at approximately anywhere between 16 to 17x. Excluding the FANG stocks, it would bring it down to 15.3x. This is actually an attractive multiple, suggesting a favorable return on investment. As per the Mastering Stock Market course, we talked about what PE ratios are. For every $15 spent, you expect $1 in return. So as the 10-year federal note reverts to the mean within its descending channel, the valuations of the so-called Magnificent Seven trade at 24.9 times earnings, right? Considering, these are the gold standard companies, and you got to pay a premium to own those. And relatively, that's actually pretty cheap comparison to other stocks that a lot of retail investors hold. Financial sector valuations post Silicon Valley Bank collapse. So in the aftermath of the Silicon Valley Bank collapse, the financial banking sector has not seen market inflows which contrarian investors might view as an opportunity. The sector's forward PE ratio stands at 12.8 times, signaling an undervaluation. Across market, the forward PE ratio is at 21.7x. Now, shifting back to small caps, there's a lot of unprofitable companies in the Russell 2000. So a good segue in the analysis of the Russell 2000 is looking at the S&P 600 small caps, which trade at an approximate forward PE ratio of 12.2, presenting a different investment perspective, which indicates that small caps are definitely undervalued, especially, which is the sniper attack we took of looking at ones that are going to be transitioning from negative free cash flow to positive. Wall Street's outlook for 2024 and inflation. Wall Street's outlook for 2024 takes into account several criteria, including inflation, With a trend towards decreasing inflation, future earnings are less likely to be compressed, suggesting an upward trajectory in stock price from an intrinsic value perspective. Now, again, let me stop here. This is the summary of our analysis. If you want a deeper dive and that explains it more thoroughly, we do have this on our stock terminal, which gives you graphs and key images and a better way to understand it. This is just an overview to put these types of things on your radar. Now, the reason being that inflation affects intrinsic value is that the dollar of earnings for the future free cash flow, inflation actually crushes that, right? Because the dollar doesn't really go that far, right? Just think of the price of the Big Mac over the past 30 years. As inflation goes down, the future free cash flows actually become more stronger, which indirectly increases the value of the intrinsic value, the price target, which is just a simple discounted cash flow statement, which is what Wall Street operates on. So if you haven't realized, for all our mastering stock market students, you're starting to see the higher level of thinking it goes into being an NFL player in the stock market, right? There are many basic analysis, right? And there's basic things that we've been teaching. And now we're basically combining everything together to formulate a strong investment thesis that can battle a hedge fund and be able to outperform it, right? Because again, they have benchmarks they have to fill, right? And they too have to FOMO as well, which is what we're basically seeing, and I'm about to get into. So the CME Watch Tool and Federal Reserve statements indicate expected interest rate cuts in 2024, which could lead to an expansion of price to earnings ratios, further influencing market valuations in accordance to what we basically said with the intrinsic value. Productivity and market growth. The artificial intelligence boom and increased investment in automation are set to significantly enhance productivity, particularly among knowledge workers. These advancements are expected to bolster overall market growth and stimulate demand. However, a current consumer sentiment metrics from the University of Michigan suggests that consumers are, given the widespread economic concern, consumers are quite worried about how the economy is. And this is largely due to the Federal Reserve's unprecedented rate hikes. An interest rate decline, equity markets may become more attractive, influencing PE ratios and market dynamics, causing an artificial stimulation of the market, including housing market, which we'll be talking and discussing in this, as well as technologies and vibrant innovations. This is, again, a full dive and a comprehensive analysis. And overall, this will cause so much from money market funds being exited and back into stocks, and just a whole slew of domino effects, and then individuals, because the market is stimulated, if you haven't realized, if you go on your commercials, you'll start to see cars trading at higher MSRP ratios in comparison to their interest rates. They'll actually giving you 0% interest rates, or near 1.9%, which is quite low. And that is to stimulate folks to buy cars, because the inventory supply is high and demand is quite crippling now for cars. But that's slowly changing. PE expansion and quantitative algorithmic analysis. To further our analysis of PE expansion, we consider a quantitative algorithmic approach. The Robert Shiller PE ratio, when compared to the United States 10-year Treasury, reveals that the average PE ratio is 18x when the common interest rates range between 3 to 5%. You're going to hear a lot of people on CNBC spew a lot of nonsense that is coming from areas of the brain that are quite primitive to a caveman, that is not backed by scientific data or analysis. In fact, if you look at the historic trends of the stock market, given the analysis anywhere between an interest rate of 3 to 5%, the PE ratios are actually 18, which is pretty damn good. This statistic is often overlooked in mainstream media. Financial commentators highlight the nuanced dynamics of market valuations and the importance of independent research to first principles thinking. Smart money versus dumb money and the equity withdrawals. The significant withdrawal of approximately $240 billion from equities, consistent with the decline in dumb money, has been corroborated by institutional Wall Street firms. It is true, we have confirmed. Retail investors have been the primary divestors following a 20% return in the S&P 500. We have never seen such outflows before. People just have a hard time picking winners. Historically, when the stock market returns 20%, there's a higher probability that it's actually going to return more in the near future. And individuals like financial analysts like Jim Cramer have advised retail investors to sell, contributing to the massive outflows. This underscores the importance of diligent, independent research in the financial world. REITs, financial sectors, and interest rates. A decrease in interest rates would likely stimulate the housing market, benefiting sectors that have struggled since the onset of COVID-19 and after the Silicon Valley bank collapse and crisis. Wall Street's strategic positioning into these sectors indicate a broader anticipation of market movement. We project a significant peak in the housing market around 2029, considering that's when the peak millennial buying will be. This is part of a larger analysis that includes inflationary pressures from the housing market and automobiles, which are beginning to stabilize. Again, this was a battle of inflation of automobiles and housing. That's, if you were to analyze the consumer price index, that's what it largely was composed of. Now, interesting that we need to talk about this. Home building needs to go up. If you analyze the home building, we're actually at a deficit right now. So we are going to see some home building companies, like, for example, Caterpillar and a bunch of other companies, be able to gain this momentum, and analyzing their earnings report as a pH test to see how, in what part of the economy, how are they doing in terms of orders, right? And in terms of home building and whatnot. And again, other stocks, Home Depot, et cetera, we're going to go look into, as the purchasing managers index is going to be oscillating and shifting from under 50 to above 50, which has its own implications regarding expansion of the economy. Technological advancements and healthcare opportunities. Technological advancements, particularly in subscription as a service, cloud computing, and generative artificial intelligence, offer significant opportunities. The healthcare sector, notably lagging in technological adoption, presents substantial prospects for growth. Collaborations like Mayo Clinic with Microsoft and Clover Health, which they're not collaborating, I'm just saying Clover Health, are prime examples of how generative AI can be integrated within healthcare solutions to decrease costs and to actually help increase the life expectancy of folks, given that there is a reduction in chronic kidney disease and failure, and also early detection of diabetes. Our ongoing analysis includes breakthroughs in mRNA technology, which you've known of regarding COVID-19, but also now being used to treat certain forms of cancer. Gene editing, for example, the CRISPR-Cas9 system, which I'm well familiar with because I am a scientist, in treating sickle cell diseases, and as well as brain-computer interfaces, which I'm also familiar with because I spent a year and a half in the lab researching this technology. Environmental solutions and the future of computing. Our research extends to environmental solutions like desalination and future computing, encompassing robotics, quantum computing, and organic batteries. These sectors are ripe for innovation and are a focus of our comprehensive analysis. And this is what I like to do in the background of my time. I like to search for this and do a first principles approach and essentially save you time. And the amount of money invested, a lot of people have made it front and back from our platform, given how detailed we go in. We go deeper than I believe we're in the top 10 best analysis for, I would say, firms for individual investors. This will be corroborated in the future. But by that time, the prices have already been locked in. So, small cap rally in Wall Street's monetary dynamics. Many individual investors distance themselves from the financial markets, especially banking stocks, following the Silicon Valley bank collapse. However, adopting a contrarian mindset is essential to understanding Wall Street's monetary dynamics. See, here's the thing. The term Wall Street signifies the barrier that separates everyday people from privileged information, hence the wall on the street. In discussions on the large cap stocks, specifically financial sector DR Fund XLF, we predict this sector will emerge as a top performer, supported by data on corporate insider buy and sell ratios, which you can access in our stock terminal platform. We give a screenshot showing the data. Clover Health and market sentiment. From a technical standpoint, the ADL line for Clover Health indicates a potential short-term rally if the support line below is secured. However, the converging area suggests the possibility of either a breakout or breakdown. This is set against a backdrop of money market funds flowing into equities, Wall Street challenging the Federal Reserve stance, and the anticipation of more rate cuts than stated. Our research also suggests that small caps with improving fundamentals like Clover Health are likely to outperform in the next decade. So overall, if you enjoyed this thorough research and this analysis, consider subscribing and hitting that thumbs up button and commenting what do you like and participating in the Q&A. Again, this is the professional table that we have, and we'll be adding more companies onto it. This is just a sample for all of you guys to see. We have long range picks, mixed picks, and short picks. And these are essentially, short picks are expected to play out between 6 to 12. Mixed are long time horizon 5 years, and then mix is in between. And for example, if you don't recall, we spoke about ticker symbol on the on stock a couple weeks ago when it was trading at $65 and was trading right around here, and we were able to see a gain of over 30%. And it's not like this is once it reaches its intrinsic value, sell. Once the intrinsic value, let's say, is on its bull case, we're expecting a 10% year-over-year return. It's not like that's the price to get out, right? Again, we teach that in the mastering. And for example, stocks like Enphase, we talked about it when it was trading in the $70 region, which you can corroborate and confirm with fundamentnews.com. And this gave you a massive 79% return. And I believe we also discussed PayPal at around in the beginning $50 region, which gives you a 20+% return. So overall, you can see that the due diligence actually pays for itself, and the analysis is pretty quite significant. And it just gives you ideologies and ideas to confirm through your own due diligence, because I can't give you personalized financial advice. I'm not a financial advisor. I'm just giving my decades worth of experience so you could say, oh, from an educational perspective, this is how someone looks at these companies. I'm going to learn and do it myself. And then guess what? We now have the data in the stock terminal to be able to do this analysis, right? And look at this. This is all of the stuff we have on the stock terminal. I'm going to continue scrolling until we reach to the bottom. And I'm not done adding stuff yet. I believe tonight I'm going to be adding more commands. But here's the auto posting. We're going to be adding the commands here. So overall, take advantage of our, I'm going to go to the comments section right now. Overall, take advantage of our New Year coupon code New Year's for $800 off. We will be increasing the mastering and the bundle to approximately $3,000. So take advantage of this, because we are not going to be seeing these prices ever, right? So take advantage of this. And yeah, it's a privilege to be able to support you guys with this analysis, and we'll turn into questions. So what about companies that do 3D printing, concrete homes? So I would need to definitely take a look at that. It's very difficult to find moats around that, because anyone can just 3D print a home. I would say you need to have some form of a moat about that. I would say can build a house in 4 days. Yeah, I mean that's definitely I would say maybe it would be a great short-term trade if you would find companies like that would be able to offset the building and see if anything is publicly traded, and obviously do your analysis and whatnot. But yeah, no, definitely looks like a great technical analysis trade. And also, I appreciate it. Thank you. And by the way, thank you for everyone who subscribed. We're at 6,000 subscribers. For the master table data, are you planning to add it to the Discord? If so, how often? So it has actually already been added. It's actually in the table form. So it's been added. And I believe we're going to be updating this every month because sometimes the investment thesis changes. And we're going to be adding and removing depending if they've essentially reached their value to a point where it just doesn't make sense to have them on there. So it should be around every month that we're going to be adding these, and sometimes weekly, depending on the opportunities that present themselves within the market. But historically, it'll be every month. We also have another thing that we are going to be releasing. We back tested it and uh, uh, data tested it here. If I can see if I can share it with you guys really quickly. Um, this is our hedge fund back testing model. Uh, we these are this is how our model performed in comparison to the S&P, Nasdaq, and Dow and Russell. Our model obviously is in blue, and you can see how we outperformed. And also we have the model analysis here, which again shows another outperformance, and we blew off the Nasdaq like no other. And you can look at the companies here. As you see, we've picked, so January 1st of 2023, we've issued these stocks here. Let me see. We issued these stocks here, and these stocks have outperformed the market. This one's up 54%. The overall portfolio has outperformed the S&P 500. As you can see, the S&P is 24%. We've essentially outperformed it by double. So these are the ticker symbols. You can do your due diligence yourself and actually look at also these picks here as well to do the analysis yourself. But we're going to be releasing this soon. We released it to our subscribers here, and we're going to be formulating it and dispersing it as well. So there's a lot of opportunity in regards to the master table here. Let me go ahead and put it here. So there's definitely lots of opportunity, and we're going to be releasing it every month. And yeah, you can subscribe or you can join the the lifetime. So, and I think the value would pay for itself. So that's definitely the goal, right? But yeah, so that's all I have for you guys. Happy New Year's. It is December 29th, and this is the last day of the market for 2023. I'm just pulling up my phone here to look at the calendar. And boy, have we made some changes. Boy, we've built out the platform. I focus a lot on the building of the data. And now we're going to focus on what is inside the platform and the amount of information. And, it's a great product. It's a great product. So happy New Year's to you guys. January 1st will be on a Monday. I believe the market will be closed, which is unfortunate, but we have to we have to celebrate. And then I believe the S&P 500 will be hitting new time highs in January. The odds are in that favor. It's all probability and odds. Let's put this, I would be very surprised if we didn't. I'll be like, that's weird. But there's a high inclination that we are going to hit all-time highs. We'll end it with looking at Yahoo Finance really quickly to see their headline here. Yeah, so again, all these stuff that's on here, it's all garbage, right? All this free information here. Nothing free in this life is good, all right? You go to a restaurant, the salads and the what's healthy is expensive, is the most expensive. So try to find folks that you trust, and I believe and I hope that we've proven ourselves to provide the best adequate analysis. We have no advertisers that influence our decisions and our analysis. We have no outside influences. My primary focus and my primary goal is to make sure our members are happy and feel like they are getting the best deal that exists in the world. Now that might sound so childish to say, but I'm shooting to become a brain surgeon, and I think I'm pretty successful at it. And future brain surgeons and brain surgeons do not settle for less. We are very calculative and precise and strive for perfection. And that's what we bring. And you can talk to each and every person in the stock terminal and the mastering course. I believe they would all come to that same conclusion. I'm up at 2, 3 a.m. They see me working. I don't bat an eye, right? Because the goal is to build out this platform and to provide the best research that exists on Wall Street. So overall, it's a pleasure. Cheers to 2023 and hello 2024. I'll see you on the next one.